we've seen also, Marie, obviously a huge jump in bond prices, driving the yield down, as we said earlier, to a 3-year low, and a big bid for other safe haven assets like the yen and gold. Do you think those trades have been overdone?
Well, I mean, clearly it skews the risk. Yeah, from these very, very low levels, you would think that asset prices are very vulnerable to a big move in the other direction. But as long as central banks are conducting the very supportive policy that they are conducting, then I think what can I say, 20–30% risk of a brutal correction in the other direction. So not negligible, but still sort of mitigated by this very accommodative central bank action.
What do you need to see from trade talks in order to be convinced that that you can get really back into risk assets, or do you think we're going to see new highs in equity indexes in any case?
Well, I think that politically, the 2 degrees of freedom that the president has in the U.S. under the current circumstances with the divided Congress is trade and foreign policy. So it's very unlikely that those levers that he would choose not to use those levers, which is why we think that trade and foreign policy is going to continue to perturb financial markets for the duration of this administration. The only solution to that would be a completely out-of-the-box solution. For instance, if Congress were to take back the trade negotiation authority that it has delegated to the president since the 1930s, if I'm not mistaken. So, that's a very unlikely scenario. So, clearly, I think from these already very high levels in risk assets, it's any gains from here will certainly be capped by these events, and in Europe, of course, also capped by the Brexit situation and indeed as well the Italian political situation potentially.